Before we really jump into the prognosis for earnings seasons across healthcare, I just wanted to take some time to remind everyone of our key key sector picks, point out some near and long-term sector performance, and highlight some key themes in the space. Now, hopefully on the slide deck in front of you is the Australian coverage universe. That's up on the screen. Most important slide deck, I would say, in this pack, really flagging our key picks from a really 60,000-foot view across our space. Now, being a defensive sector, really hasn't mattered much at this threat-studded, unpredictable start of the year. The sector is down 8% versus the broader market, down about 2.5%. We don't have to belabor the uncertainty with the Feds for rate hikes, historically high inflation rates, throwing some geopolitical tensions, fallout from distressed value chains. And let's not forget the pandemic's overshadowing of the economy, dare I say, self-imposed. Against this backdrop, our preference is for really high-quality names. That should be expected, where COVID has really strengthened the business model, assured increasing resilience, or sitting on a strong capital position to weather any storm and see earnings upside potential. So on those names on this slide, we have circled in red those names. Let me just quickly touch on them because I said this is the most important slide in this deck. Medical device company ResMed did get marked down coming off of a soft quarterly result a few weeks ago, mainly on supply constraints and higher freight costs. Nothing really unusual there. It has quickly recovered. Good to see. Managed to put up double-digit product sales, strong demand, recovering patient volumes, all moving in the right direction. We do have some headwinds, though. Supply and variability of freight will continue near term, but we gained some confidence because management said the outlook is much stronger, expecting acceleration of industry growth up to 100 bips for quite some time. Growing patient volumes, backlog of medical services, and the adoption of digital health technologies increasing the focus there. Let's not forget some increased focus and some would say obsession on respiratory care and hygiene given COVID. Now, moving on to the service providers, a bit of a change here. We are leaning much more toward Healius in lieu of Sonic. Now, Sonic has been our top sector pick throughout COVID, as it was all about testing, and more testing. It's performed quite well, outperforming the market by nearly 30% since March 2020. Now, we did flag 6 months ago that we thought COVID would likely get worse before it got better on the emergence of variants. And of course, PCR testing will continue to drive the stock higher. Now, that was despite the inevitable declining earnings trajectory off the back of multi-year COVID highs. Now, Omicron obviously has hit late November, saw PCR testing hit all-time highs, 2.4 times more than the average last year. Now, January and February, the daily averages for testing are elevated on PCP, but they are coming down on a sequential basis, as we expect. And antigen testing is increasing, obviously. Throw into the mix a U.S. supplier reporting lower than expected volumes and a high PE growth sector out of favor. And I think we've missed the top, unfortunately, in this name for Sonic. But Healius also should benefit near term from COVID testing. Is definitely not immune from the declining of PCR testing going forward. But we do see more upside, 200 bips of margin expansion from ongoing cost out program over the medium term. That drives a 26% EBIT CAGR from 2019 to 2023. That compares to Sonic at 18% and does offer more valuation support than Sonic, trading roughly below a market multiple of 15 times. That's 30 to 40% below Sonic at 21 times, and that's a lot higher than the discount to Sonic historically, which runs at 10 to 15%. We're also going to keep our positive stance on the in vitro fertilization names, IVF names, Virtus and Monash. Continued strength in cycle numbers there, even cycling high post-return of high highs from post-return of elevated surgeries after COVID, and the industry's fundamentals remain strong. For Virtus, we look at a bidding war, possibly. We have BGH Capital's punt at 710. That was trumped by CapVest at 760. The exclusivity period for CapVest, recall, ends next Friday. Wouldn't be surprised to see the offer sweetened or another punter lob a bid. So for positive on that name. For Monash, positive AGM. They really flag share gains and high level of patient inquiries, points to a really solid earnings outlook for them. Turning to biotechnology quickly, we're still sticking with the Donnie Bradman of the space, CSL. Really in the crosshairs, I would say, in a perfect storm, down 17% over the past quarter. That's really an ongoing uncertainty around a full recovery in plasma collections. But our channel checks indicate that things are improving, which is good. albeit the costs are going up faster. Not good, pressuring margins and earnings. Now, we throw into the mix their $4.5 billion placement to help fund a roughly $12 billion punt for the Swiss-based company Vifor. Market's still trying to digest that. And the sector is currently unloved. The share is trading 7% below that 273 placement price. Now, I think this is a case of throwing the baby out with the bathwater here, as near-term challenges with plasma collection aren't structural. The Vifor transaction we view as a positive, as CSL kind of getting another growth leg in a defensible specialty product portfolio, strong market positions and growth opportunities, and shares look attractive here. They're trading at 30 times. That's below their long-term average of 34, and at a 5-year PE premium relative to the ASX, a 5-year low, I should say, to the premium to the ASX 200 Industrial. But I would just be waiting until the first half reporting next week before trying to pick this up off the bottom, as we expect that result to be a little soft. Now turning to healthcare technologies, we do prefer Medicus. This is a high-quality growth name. Obviously, has taken it on the chin during the sell-off across the space, down nearly 19% over the past 3 months, but does offer cutting-edge medical technology, long contracted base to drive revenues across the who's who of the space, and is leading that shift, the paradigm shift, we would say, in the industry is historically laggard in the IT adoption. Now, next slide, I'll run through these quickly. Sorry, James. This is looking at the sector performance 12 months, lackluster as you would expect, underperforming the broader market by 10%. Really kind of followed the COVID-related gains that you would expect. Did turn up off a strong fiscal 21 reporting season back in mid-August. And that was followed by a rapid rise of Omicron infections in November, so it did do better, but obviously it's taken a body blow post-Christmas on the sell-off of everything tech and growth-related. Next slide, James, thanks. This is looking at the next few years, what the prior few years had made. It's amazing how things have changed around so much. It's complete opposite of what's happened 2 years ago. The sector was the bee's knees, returning 22 points above the market. Next slide, James. Adding more granularity to this performance, we see a lot of red on this sector. As you said, the sector's been on the nose, underperforming the broader market by 6 to 11% over the 1, 3, and 6 months, 12-month period. Even underperforming other safe havens of telcos, staples, and industrials over that time. However, we look at the COVID beneficiary trades, managed to eke out a performance on the year. ResMed, our key pick, is up 30% over that time. So our testing companies, Sonic and Healius, up 11%, but only ResMed has been able to hold on to those gains over the last month with the market sell down, outperforming the broader market by 5%. Next slide, James, sorry. Are you keeping up with me? Sorry, I'm trying to run through this quickly. The valuation of this slide kind of looks at the sector, obviously out of favor, has degraded with those high PE names, as I pointed out. But valuation, it's hard for me to say. It looks attractive. It's always kind of expanded or excessive. Now it looks attractive, trading 1 to 3% below its 5-year PE on both the mean and absolute basis. Next slide, James. Now, I love this slide. This slide should be looking at the longer-term focus of the market, kind of bypassing the market's short-term sidedness. The sector has outperformed the market by 80% of the time over the last 11 years on this slide. Best performing asset class in the ASX, a CAGR of roughly 17% versus roughly 6% on the ASX. Really in the back of strong growth fundamentals and secular growth throughout the space. Next slide. Now, we believe these structural tailwinds will remain intact. And I put this slide up just to show the sector should regain favor, we believe, with investors, especially as the business cycle moves from the mid to late cycle stage. Next slide, James. So just some key thematics. I won't belabor this given the time, but I just wanted to touch on a couple of things. 26 months and counting. COVID remains in the headlines unbelievably. But thank goodness that it looks step by step that many countries, from England to France, Ireland, Switzerland, are easing their COVID restrictions amid hopes that Omicron wave may have passed its peak and the endemic phase can begin. Sweden even officially declared the end to all restrictions last Wednesday. I wish I could say the same for Australia, but certain restrictions do continue, and we will now need 3 COVID vaccine doses to be considered up to date with your shots. Now, that is of last night. The government's immunization advisory body recommended everyone over 16 and older receive a booster 3 months after their primary course, or they'll be considered overdue if it goes more than 6 months. Now, no mandates were pushed through, which is good to see, except for aged care workers. And the decision is really left up to individual states to set their own rules. Now, we do have the Victorian Premier already saying that you need to be fully vaccinated for 3 doses. And the state may ban people from going to pubs, clubs, and restaurants and major events unless they are boosted. And this could apply to international tourists as well. Queensland Premier has already hinted that she may follow suit. I'm still waiting for the other premiers to see what they're going to do. I won't belabor the other key thematics on this slide, but they are important, from enterprise imaging to hospital without walls. And a key focus on the space is diagnostics, international names, and of course the Aussie dollar kind of keep front and center as we think the RBA will get more hawkish and move that dollar up higher, which is a headwind across the space. Now, last slide I have, James, hopefully you stayed with me. The reporting season. Very difficult to pick winners and losers here. Handful have reported guidance or given guidance. All cycling hits due to the outbreak, obviously. There's no really good consensus numbers, kind of wide variation amongst the analysts. Far be it for me to say we believe a lot will be in line. Nonetheless, of the ASX 100 names, we do see upside in COVID testing for Sonic and Healius, as I already discussed. We're looking for strong results from IVF player Monash, as well as I also pointed out. Downside risk, COVID-induced headwinds. I did point out CSL. Cochlear is in that same boat. We look for picking up that stock below 190, which it did break through briefly last month, but looks good buying around those levels. And I'll put out Ramsey. We like the stock below 60.